You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
All right, everybody. That music means it is time once again for Interview Tuesday here on the old Options Insider Radio Network. It's the day of the week where we welcome on guests from throughout the world of options and derivatives and indeed beyond, and proceed to pick their brains for the benefit of you, the listener. Like the man said, my name is Mark Longo, coming at you here from our Options Insider studios in not that scenic, not that sunny these days, Chicago. A little bit warmer than it has been of late, which is nice, but it is that time of year. Of course, it's also that time. If you guys like what you hear on the full network, make sure you keep those reviews coming, so that new people can continue to discover not just this program, but indeed the full network. We've seen a massive influx of listeners over the past 6 months. We want to keep that going. Of course, it's more important than ever in these troubled times out there for new people to have a reliable source of information on volatility and options and all the things we discuss here on the network day in, day out. So if you like what you hear, you want other people to continue to discover the network, keep those reviews, those comments coming. Keep those questions coming, too. We do love to hear from you guys. Let's see who we're going to hear from on the program today. Our guest is a newcomer to the network. He is Mike Loukas, the Chief Executive Officer at TrueMark Investments. Mike, welcome to the Options Insider Radio program.
Thank you very much, Mark. Happy to be here.
And Mike, as we are wont to do with all of our first-timers here on the program and indeed on the network, why don't you go ahead and give our audience a little bit of an overview of your background in the financial space, as well as what the heck it is you guys do at TrueMark Investments.
Okay. So hopefully those dovetail together as I work through it. But, my background in the investment business spans, let's see, how old am I now? Close to 25 years or so, 24 years, ranging from a variety of products, mostly on the retail side in the 40X space. I've dealt with everything from option funds or options related funds, both mutual funds and otherwise. I've dealt with real estate. I've dealt with emerging markets. So, we've been across the board in sort of the breadth of our experience. But I started out right out of college back in the Dean Witter trading program, down in the World Trade Center back in the mid 90s. And progressed from there throughout the different layers of the business. And I think when it came to, you get to a certain point in the business and you realize that, there are certain things you gravitate towards and certain things you don't. And when you do gravitate towards it, if you have the opportunity to really captain your own ship and start a company and do it the way that you and your partners think it should be done, quote unquote, then you jump at that opportunity. And I think at TrueMark, our management team, we're all at that stage of our career where we've been around the markets on different asset classes, big companies, small companies, and we've come together to launch an ETF issuer that we think is pretty timely. And TrueMark has a few goals that underlie or are the foundation of everything we do on a daily basis. And first and foremost, that goal starts with the ETF space. We think is certainly ripe for another expansion, another leg of its expansion, if you will. And as we saw in the ETF space in the early days, a lot of the product was passive. As it starts to branch out towards different types of investment approaches, we think active management is the next wave in the ETF space. And so we embrace that fully. We also believe that fee compression is real. And so the ETF space offers some opportunities to help manage a business model while accounting for fee compression and certainly taking advantage of the different tax efficiencies and various characteristics of ETFs that make them so popular. And then we believe wholeheartedly in not only the new economy and sort of the burgeoning nascent asset classes we're seeing as the economy digitalizes, if you will, but we believe in finding new solutions to old problems. And that particular point, I think, is what really brings us to our options-based products, which we believe are a new solution to an old problem. But TrueMark, in a nutshell, really stands on those principles. And the TrueShares ETF lineup, we hope, reflects that pretty much on a daily basis with everything we launch.
Well, let's get into those a little bit then, because you're obviously operating in an interesting niche in the space. That's certainly an interesting time as well. We, of course, are in unprecedented markets every week, every day. It seems like something new and different and often unpleasant seems to be happening in the broad marketplace. So these are interesting times to be offering a product that offers effectively an overlay component. And a lot of people are coming to us these days across all of our different audiences, retail, institutional, advisor, all of the different spectrum they're in. And they're saying, hey, these markets are crazy. We're interested in hedging. So there certainly is an audience that is primed for this out there, Mike. So let's get into it. What are you guys offering on the options-oriented space? What are you guys bringing to the table in the overlay space, sir?
We have a series that we call the TrueShares Structured Outcome ETF series. And that series focuses on a segment that has become known as the defined outcome or buffered ETF space. And realistically, what we're talking about here is we're talking about equity exposure, via the S&P underlying that can help everyday investors manage volatility while maintaining that exposure. And it may sound rather simplistic to options experts, but I can tell you that the reception of this type of approach in the marketplace and the user-friendly or investor-friendly nature of the ETF structure has really created a great groundswell of support for this approach. And as you mentioned, it has a lot to do with the fact that 2020, in every sense of the word, has just been a rude awakening when it comes to the idea that volatility never went away. It may have just been a little bit sleepy for better parts of 10 years. So we're seeing some extreme volatility coupled with a low rate environment. And so when you look at the way most investors approach their portfolio construction, what you generally have is some sort of risk parity approach, whether it be a 60-40, equity fixed income allocation, 80-20, 70-30, depending upon the target needs of the investor. But the yield half of that allocation is not pulling its weight. And so you're faced with very low yields. You're faced with extreme volatility. And, we often in our presentations, we talk about the 20 largest volatility-driven declines and sort of the 20 largest one-day increases in the VIX. And while you'll always see a smattering of 2008 in there, the top two have been in 2020. And so this year has really been unlike few years that we've come across. And so I think the need for equity exposure remains for investors of all segments, but that fear of volatility has never been higher. and maybe justifiably so. And certainly what we try to do is we try to give investors a tool to help manage that volatility so they can maintain the equity exposure they need, so greatly in this type of market. And how we do that, it's an options-based approach. What we'll call is essentially replicating the characteristics of a traditional structured note, but we're doing it with some distinct advantages to the wrapper. It's got liquidity. It's got no credit or counterparty risk. It is tax efficient and extremely low minimums. It's a traditional ETF structure. So there is a way for investors to harness another volatility management tool that really wasn't around in the ETF marketplace up until the last year or two. So we think it's got a great audience out there. It's very versatile. There are several approaches to it. Our particular approach, we like to say it's bullish. So we believe in the inherent positive return bias of U.S. equities. We also believe that volatility can damage portfolio construction. It can really rattle investor emotion. There is a need for volatility management. So how do you marry those two concepts? And the TrueShares Structured Outcome Series, we believe, is the best way to do that.
Well, let's get into the methodology here because our audience likes to get into the weeds a little bit. Of course, you're talking about what you term your structured outcome ETFs. I'm looking at the September ticker, which just launched the beginning of this month, September 1st. So effectively, you're offering a collar for the listeners out there. Is that an effective characterization there, Mike?
Yeah, I think so. It's the uncapped approach, which we utilize. I mean, I think you'll see some other approaches in the marketplace that give you a downside buffer and then an upside cap. We use a downside buffer with an uncapped approach, which is based on percentage upside participation. So realistically, the underlying mechanism is two options positions. So it's a lot simpler than some of the other mechanisms out there. And when we approach it that way, there are some nuances to it that I think start to come to the forefront. One, that upside capture ratio to us is a much better way to capture that idea that inherent positive return bias in the U.S. equities will play itself out over time. And if you look at 12-month rolling returns, having uncapped upside participation does play out over the long haul, and that's important for compounded returns of investors. So underlying the actual product, you basically have your selling puts at, we'll call it 10% below the market, and you're buying at the money calls. And your upside capture is going to be based on the skew between those puts and calls. Now, the catch here is that we put that position on day one. So on day one, you're going to get a predictable profile to your investment outcome. And that profile is only truly harnessed if you carry this investment for 12 months. So we're using flex options. They're 12 months. And we put the position on to run for 365 days. And then we will roll into a new position after that 12-month period expires. So an investor doesn't have to do anything except stay in the fund to reset that position every 12 months. But generally speaking, these buffered or defined outcome approaches will use flex options, apply a 12-month position or investment period, and roll them every 12 months. It doesn't mean that investors can't get in and out, intra-investment period, we'll call it, over the life of that contract. But it certainly takes a little more education to trade these tactically than it does to buy on day one and hold for 365 days.
It's interesting. So you're using a different approach than I initially assumed. People traditionally come to us with their overlay funds and they're holding a long underlying position in the S&P or a stock, whatever it might be. And then, of course, they're buying the put and trying to write some sort of covered call against it to offset some of that cost of that put. The downside of that, of course, is that it's never going to pay for all of that put, just the way stocks are in the market out there. So you're never going to get enough juice in that call. And of course, as you mentioned, it also caps your upside, but you're going the other way. You're going actually selling that put and buying that the money call. So a bit of a bullish risk reversal, which is an interesting approach. How did you guys land on that approach versus the more traditional collar type structure there, Mike?
Well, I'd be remiss if I didn't give credit to our very astute sub-advisor on the product, which is Spider Rock Advisors out of Chicago. They're in your backyard.
Never heard of those guys. I've never been on the network at all. So Eric Metz is to blame for all this madness?
Eric Metz is absolutely to blame for all this madness. And we thank him for it, ironically. So we work closely with Eric and his team to develop these strategies. And again, it really is predicated on the idea that if you look at the data, if underlying this approach, we quickly realize that a 10% downside buffer, or downside cushion, if you will, is a sweet spot in a lot of different ways. A sweet spot because it's one of the more popular contracts out there, so we're selling into a good premium. But certainly, when we go back and look at the past 30 years and we look at what volatility is done in the marketplace and we look at the snapback that generally occurs after a large volatility-driven decline, we have to realize that, and we have to engage what those snapbacks typically look like. So for us, we wanted to do a couple of things. Again, we wanted to try and have an uncapped upside because we wholeheartedly believe in the potential of that snapback. And we don't want investors to lose out on that snapback or in any way, shape, or form get whipsawed. So it's important to us that we maintain that bullish stance. And the 10% number to us, anything below that, sometimes optically, if you have a 15% or 20% cushion to the downside, that can give an investor, a little more warm and fuzzy feeling. But we believe that you're paying too much for any cushion that's deeper than 10% down the downside, and you're sacrificing, your potential capture of that snapback or that inherent positive return. And then further, by using only a 2-position mechanism, we also realize that advisors and investors alike will probably tactically trade these over the course of its lifespan. And that 2-position mechanism allows a much better correlation to upside moves of the underlying than a mechanism that provides for a capped upside, because you'll just see more positions and in more competing directional positions in that underlying mechanism. So yeah, this is the brainchild of Eric and his team, and they really practiced it or still practice it internally at Spider Rock in an SMA format. But it's also something that we discussed at length when we talked about launching this 40 Act and launching a liquid, tax efficient ETF structure for that approach and what would resonate in the marketplace. And this to us is really the intersection of the science behind that position and the need of the general investing public at this point in time.
And in the structure of it, we'll get to the risk reversal in a second, too, because I have some questions about adjustments and all that fun stuff that I know our audience is going to send in once they hear this. Are going to head them off the past now. But you have an interesting structure outside of that as well, is that you're issuing new ETFs effectively every month. So I mentioned the September ETF launched on September 1st. You have a new one coming out in October. So this is going to be effectively a monthly issuance going forward. Is that the plan there, Mike?
That is the plan. Yeah, we had the first launch in July, and we'll go ahead and launch these continuously until we get 12 out there. And that allows additional versatility to advisors and investors that want to ladder their clients out. New money comes in. Market movement obviously is a big deal. So the uncapped upside truthfully allows a little more freedom to move in and amongst that series of 12 different ETFs depending upon market outlook and historical performance or performance of the series that you're in. So we will launch 12.
And, you mentioned the uncapped upside, but I know obviously we've had some tumult to the downside this year as well. So let's say during the lifespan of one of these funds, we just launched September, for example. Let's say during the lifespan of September, we have another March sell-off where the market just, the bottom falls out. You mentioned you're going to adjust them and roll them at the end of a year, but what about during that year? Are there any adjustments? Like, for example, in that scenario, we have a repeat of March. Would you guys take off the put, adjust the put strike, adjust the call? Are there any adjustments going on there, or is it effectively set it and forget it until the 1 year period is up?
Set it and forget it. So, we're not going to market time it. We're not going to adjust according to the market. Because of the uncapped upside, it allows an investor to actually do that themselves, right? So if you are in, let's take what happened in Q1, Q2. So if you were in March, you had a series that was maturing at the end of March 2020. Market bottomed out, I guess March 22nd, March 23rd, somewhere in that neighborhood. Now, if you're in a capped version of this, if you reset that position on the first trading day of April for another 12 months, you're lowering your ceiling, right? So in that circumstance, there could be some reason to go ahead and adjust those positions midstream, right? Because you don't want to lower your ceiling on that investment and then get whipsawed. With an uncapped upside, if you're rolling from March and your position's resetting for 12 months, and that starts the first trading day of April, you're automatically going to lower your floor. You're going to establish a new buffer from where the market is that day, and you'll still have an uncapped upside. So you're not going to truncate that recovery or snapback. So that allows the actual fund to accomplish the same goal, particularly when you have 12 of them out there. And because they're ETFs, because it's a very simplistic process moving in and out of the ETF, advisors and investors can do that at any point in time when 12 series are out there. So if you're in a July series or September series, market's down, you want to lower that buffer, then you have the opportunity to do that in October. And lower that buffer, but still maintain an uncapped upside with a percentage upside capture. So that flexibility is built in. It removes the need for us to go ahead and get involved in the mechanism midstream and corrupt that 12-month profile.
So it's fair to say then you're targeting a little bit more active end user, active investor out there, and you're relying on them to do a little bit of the market timing as opposed to building that into the product yourself there, Mike.
Yeah, we're leaving the choice to them. I mean, they can get involved in the tactical trading, or they can set it and forget it and realize that, markets aren't linear. So, we may see a dip around the election. We may see a recovery in January. We're going to see lots of volatility, and that's what it is. But understanding that there's an ebb and flow to this generally would allow an investor to be comfortable, the set it and forget it approach. Or if they have an advisor or personal market outlooks that they would like to adhere to, we're putting enough options out there, enough different funds out there where they can go ahead and tactically trade those themselves.
Like I said, these are interesting and or unprecedented times to be out there marketing any type of product, let alone effectively a bullish risk reversal product. You said you've been live since July. What has the response been like so far?
We think it's been solid, and we're seeing a gradual increase in adopters of the product. So July being the first one, and sort of the first of its kind with the uncapped upside. We saw some people dip their toe in the water, want to see how it behaves. We've seen a gradual uptick in adopters of the product through September, and we're expecting a pretty solid that's pretty solid fundraising season here in the fall, particularly with what most people expect to be a fairly volatile couple of months on the horizon, if not longer.
And certainly the aggressiveness of the recovery post-March has worked in your favor. So I'd imagine that's made a little bit of the selling process easier over the last few months. Do you expect that to get complicated a little bit if we do see some more turbulence for the next couple of weeks or months like we have over the past few weeks, Mike?
Yeah, it may. But again, there are several issuers in the defined outcome space, all with somewhat different approaches. So there's a tool for all seasons, right? Depending what people feel more comfortable with, there's a tool for them out there. We are a tool for those that are looking to manage that volatility and believe in the inherent, bullishness of U.S. equities, or the inherent positive return bias. So, even in the face of significant volatility, which, personally I fully expect, moving through not only the Supreme Court battle, but certainly the election, I think that people that have different needs in terms of quelling emotion or, like I said, maintaining equity exposure with a corrupted sort of risk parity model because of the low yield environment, they'll be attracted to this type of approach. And, we believe that over the long term, this will always play out in a positive way. And certainly that's the underpinning for the approach we chose.
Well, Mike, unfortunately, that music means we've come to the end of our journey here on Options Insider Radio. I want to thank you for joining us. We're always interested in more actively managed options-oriented products out there. It's certainly a small area of the space. We're glad to see that it's growing in a variety of strategies, including your own. And Mike, if our listeners are intrigued, maybe they want to learn a little bit more about your structured outcome ETFs, where should they go? What should they do, sir?
Well, they can easily get to our website at www.true-shares.com. They can email us at info@true-shares.com, or always give us a call the old-fashioned way at 877-774-TRUE, True. And we'll have someone always on hand to help educate or answer any questions they have.
There you go. Check it out for yourselves. TrueShares, TRUE shares is the product to look for. And Mike, we'll look for these products out there in the marketplace, and we'll keep an eye on how they perform in the coming months.
Sounds great. Thanks for having me, Mark.
And thanks to all of you out there for joining us today on Interview Tuesday. Remember, if you like what you hear, keep those reviews coming, not just for this program, but for the entire network. We have content hitting you pretty much every day, sometimes multiple times a day. Education Wednesday, so OPR, Options Bootcamp, coming at you tomorrow. Of course, Thursday, we have TWIFO, This Week in Futures Options, as well as, of course, second episode of the Option Block Friday Volatility Views. Going to have the Advisor's Option later this week as well. So a lot of great content for you guys to check out. You know where to find us. Just search for Options Insider on any of your leading platforms out there. And it's all there. And, of course, leave those reviews if you like what you hear. And we'll see you back here throughout the rest of the week of all of our content before we kick it off again next week with another episode of Options Insider Radio.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.